You're listening to Real Investor Radio with Fuhr and Jack BeVier, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Hey, it's Fuhr and Jack BeVier with Real Investor Radio, and we've got a couple quick hits today for you. Jack and I wanted to jump on today and talk about the recent Fed announcement and the 50 basis point cut in the overnight lending rate. Jack, I know you've got a lot to talk about. We've been hearing from investors all over the country, Jack. The phones are ringing quite off the hook, quite frankly, over at Dominion Financial right now. So wanted to get your quick take on where we are in sort of not only this election season, but also in terms of the economy, what we're seeing, and why Powell decided and the FOMC decided at this point to really kind of surprise a lot of people, Jack, who were probably expecting a 25 bips cut. And then we wound up getting 50 instead, with a potential promise of more coming before the end of the year. So give me your hot take on sort of, well, first, I will say that for anyone who listens to the podcast frequently, and thank you for listening, it's not something that I think surprised you and I, Jack, because you and I have been talking about it now for several months of, sort of what we might see towards the end of the year from the Fed, especially given the fact that at the beginning of the year, they talked about 3 rate cuts. Then that seemed to cool, right? And, waited, 4 rate cuts, right? And so now they're, end of year and gave us a 50 bips cut and talking about an additional one by the end of the year. So Jack BeVier's hot take, here we go.
Yeah, the 50 surprised me because it's interesting because it raises a couple, it infers a couple things, right? It infers that the Fed really feels comfortable that they have inflation under control and that they've slayed that dragon. And apparently Powell's not concerned that inflation is going to come back in the short term. That's one inference that you can take from that. And it's a move that they made, which was more aggressive than the market was even expecting, right? More aggressive than the market had priced in at that time. So that's one piece that it infers, which is good for mortgage rates, because the mortgage rates, if the Fed has quelled inflation, not that the Fed dropped rates, that's not what causes mortgage rates to drop.
Of course.
But if the Fed believes that inflation is under control, then long-term rates start to come down, because those long-term investors are like, well, I'm not going to lose ground to inflation anymore, so I can accept a lower return for having my money locked up for longer and not worry that I'm going to lose money to inflation along the way. So
right.
We've seen a big drop in the 5-year and the 10-year over the course of the past 60 days. That's one of the main drivers for such a spike in DSCR activity. A lot of guys are getting off the sidelines right now, taking advantage of that drop in DSCR rates. I think we're quoting in the low 6s on a regular basis for kind of like down the middle stuff.
Yes.
Which is exciting because it makes the numbers work again for building a rental portfolio.
Yeah, well, let's go back quickly to, I want to break it down for real estate investors because that's our listening base. But what you were saying is mortgage rates. And so if the Fed comes out with a 50 basis point cut in the overnight rate, that may signal to the bond market, which is what mortgage rates are sort of based off of, indexed off of, that, hey, there's, we've got the economy under control, which you and I can debate. We're going to bring it in for a soft landing. And those who invest in the 30-year or the 10-year, more likely the 10, might say, hey, you know what? My money feels safe right now. Let me go ahead and invest in that 10-year bond, which then would price down mortgage rates for, regular consumers, right? Like folks who are buying houses or want to buy houses, which is great. But Jack, let's talk about how DSCR rates are indexed, because we're getting calls every day from borrowers who own 1, 2, 10, 50 properties. I mean, I get calls all the time. Hey man, we saw the 50 basis point cut. Tell me where I'm going to be today. And I think that there's a cautionary tale there for those folks, because even though these DSCR loans are indexed off the 5-year bond, Jack, we haven't seen a commensurate cut.
Not another one.
The bond market hasn't caught up. The 5-year bond market hasn't caught up to the 50 bips cut yet. And
Well,
I think you might argue, Jack, that like maybe that 50 bips cut has already been baked in.
Yeah, I was going to say,
Yes?
I think it was baked in beforehand, and they were expecting it, and the reason we haven't seen much movement since in the mortgage rates since the Fed since the Fed rate cut, is that, one, to the extent that the market already expected a rate cut, that got priced in a month before, right? Like,
Agreed.
And so it was already in there. And the Fed's the Fed dropping to 50, the reason we didn't see another, bigger drop as a result of that is because I think that rate drop indicates two things. Not only does the Fed indicating that they think is inflation under control, good for mortgage rates, should bring treasuries down, but it also, because it's a little bit aggressive, infers that the Fed's a little bit worried that we might be heading into a recession.
Correct.
And so, though the index can be lower, the credit spread may need to go a little bit higher. And so, mortgage rates just kind of called that 50 basis point decrease a wash between lower index, the probability of a lower index and the probability of a higher necessary credit spread, because if we do enter a recession, the risk involved in that would lead lenders to demand more return for putting their money at risk.
Yeah. So let me see if I can break that down for folks who are listening, who are probably asking, like, you want to give us a call and you're thinking, well, like, hey, Craig quoted me 6.5 3 weeks ago on a 75% cash out on a rental property that I have. Boy, that should be much lower today. When in fact, what I think you're saying is, one, that 6.5, we've probably been quoting now, Jack, for about 6 to 8 weeks, correct?
Yeah.
And I think if I hear you correctly, if the note buyers who we sell the DSCR loans to, Jack, believe that, yeah, we've kind of baked in that 50 bips cut already, and we sort of believe that there might be a recession looming in 2025, let's say, they might even start increasing the index that they charge for the loan, correct?
The credit spread.
Their credit spread. Yeah. So that basically they're taking a little bit more revenue for the risk that they perceive as coming.
Yeah, that's right. Yeah.
So I wrote today in my LinkedIn, Jack, and I hate to shamelessly promote it, but it's just look for me on LinkedIn at Craig Fuhr, Fuhr. And one of the things that I mentioned in it was just that we think that the economy is not nearly as rosy as might be perceived by the Fed or maybe by politicians in DC. I think that many Americans, Jack, are still feeling a lot of inflationary pressure, and not only in home pricing, home heating. We've talked about the rising cost of insurance around the country. We've talked about grocery prices still very high. I just don't feel, Jack, that the average American is feeling this, soft landing of inflation that the Fed is, kind of signaling that they might be feeling.
I tend to agree. I tend to agree. For Dominion's portfolio, I put in a big tape of 85 properties.
You didn't refinance, but you didn't call me for that loan, Jack.
To refinance all those properties, because I got 2 bank loans coming up. I got a bank loan coming up at Thanksgiving, and then one just before Christmas. And I was like, oh man. So I actually threw those into the pipe to refinance those right now, because I'm anxious that I don't see a clear path for rates to continue to decrease, particularly within uncertainty in the world. And so, for my money, we're refinancing everything I can right now. And I also switched a lot of properties that are in our pipeline right now from a retail exit selling to homeowners to keeping it as rental properties. Days on market are continue to tick up. We missed the spring selling season. And the lower mortgage rates haven't led to an increase in showings. If anything, showings since Labor Day have sucked. So I'm more confident in my rental exit right now with these lower DSCR rates than I am in a retail exit to a homeowner. So that's how we're thinking about the world.
You know, you pivot a little bit here. You sent me a great email today with sort of home appreciation. It was a Case-Shiller index. And in many markets around the country, we're still seeing about a 5% year over year growth in home price appreciation, Jack, which only makes obviously homes less affordable for those looking right now. And I think maybe the silver lining is that mortgage prices on a 30-year for homeowners will maybe decline a bit over the coming months. Though I think, if I hear you correctly, we're a little dubious as to whether or not that might happen. I will say that did a little research prior to the show today, and there has been increased demand over the last since the rate announcement for the 10 and the 30. The 10 is actually down. 5-year, if you take a look at it today, Jack, it's actually been heading up. Kind of volatile. Within a half a point or two, or I'm not even a tenth of a point or two, but it has not exactly been, coming down like most think it would since the rate cut announcement.
Yeah.
So, anything else you want to add?
No, that's a recap of how I'm thinking about the world right now. We'll see if the Fed does another quarter point at their next meeting. I got one more to add. So, and you know what? We'll transition it into. I'll tease the next little segment as I do it. So, I want to talk about what the Fed's going to do on a going forward basis and how that's going to affect the economy. So, if you look at the Fed's dot plot, which is basically the board of governors, all the different Fed chairmen, what they project, what they think is going to happen, what rates are going to be on a going forward basis, they project that out. I think it's a year. And if you look at that dot plot, they're talking about, they think, short-term rates, the overnight rate is going to come down almost 200 basis points over the course of the next 12 months. I think that's going to have a significant impact on banking, and that is going to trickle down into the real estate investor economy.
How so on banking?
We're going to talk about that on the next episode. So tune in. Just click on that next one where we talk about what the Fed's going to do for the next 12 months and how that's going to impact you as a real estate investor.
Jack BeVier with the awesome tease. All right, this has been a quickie on the Fed rate cut from Real Investor Radio. I'm Craig Fuhr with Jack BeVier. Thanks for tuning in.